Before we begin, a quick and important disclaimer. This documentary series discusses the economic, legal, and financial aspects of insurance products. The information presented here is for educational and entertainment purposes only and does not constitute professional legal, financial, or insurance advice. Every individual situation is unique, and insurance policies vary significantly based on state laws, carrier agreements, and personal circumstances. We strongly urge you to conduct your own due diligence and consult with qualified legal and financial professionals before making any decisions regarding your personal or financial planning. Imagine you are standing at the altar. The music is swelling, the guests are teary-eyed, and you are committing your life to another person. It is the most romantic day of your existence. But what if, in that very moment, a forensic accountant handed you a spreadsheet detailing the statistical probability of your future financial ruin? In the United States, roughly 40 to 50% of first marriages end in divorce. That is not just a personal tragedy. It is a massive, often destabilizing economic event. Now, consider a world where that financial volatility could be mitigated before the first piece of wedding cake is even sliced. We are talking about a concept that sits at the intersection of love and liability: divorce insurance. It sounds like an oxymoron, a cold-hearted bet against your own happiness. Yet it is a growing conversation in high-net-worth circles and among those who have seen the catastrophic toll of marital dissolution. Why are we talking about this now? Because the economic landscape of modern marriage is shifting, and the traditional safety net of alimony and asset division is proving to be increasingly unreliable. This is part one of a 10-part masterclass on the economic value and potential of divorce insurance in the United States. Today, we are opening the loop on a topic that mainstream culture is afraid to touch. We are going to deconstruct the myths, analyze the cold hard data behind marital economic failure, and explore whether the concept of insuring a marriage is a visionary leap forward or a dangerous precedent for human relationships. The core problem we are solving today is the issue of economic uncertainty. When a marriage ends, it is rarely a clean split. It is an asset liquidation event that often destroys years of wealth accumulation. Think about the dual-income household. Both parties contribute to the mortgage, the retirement accounts, and the children's education. When that partnership dissolves, those contributions stop, legal fees skyrocket, and the economies of scale that allowed for a middle or upper-class lifestyle vanish overnight. The U.S. divorce rate has remained a constant pressure on the economy for decades, costing billions of dollars annually in lost productivity, litigation expenses, and social safety net interventions. For the average American, a divorce can mean the difference between a secure retirement and working until age 80. To understand why this is a necessary deep dive, we have to look at the historical trends of divorce in the U.S. In the 1970s and 80s, the spike in divorce rates changed the American family structure forever. Laws shifted to no-fault divorce, which made ending a marriage easier, but also removed the clear-cut financial guardrails that existed when one party had to prove marital misconduct. Suddenly, the financial future of both spouses became a moving target. If you enter a marriage today, you are essentially entering a business partnership where the exit strategy is largely determined by state law and the mood of a judge, rather than a contract you personally negotiated. The potential of divorce insurance is not about profiting from a breakup. It is about risk management. When we talk about insurance, we are talking about the pooling of risk. We insure our homes against fire and our cars against accidents because the financial hit of those events would be too great for an individual to bear alone. Divorce, by the statistics, is statistically more likely than a house fire. Yet, we manage it through an adversarial legal system that often costs tens of thousands of dollars just to initiate. The promise of this concept is to provide a standardized, predictable financial floor for spouses when a marriage concludes. Consider the case of a spouse who leaves the workforce to raise children. They sacrifice career trajectory and pension contributions for the sake of the family unit. When the marriage ends, they are often left with a significant wealth gap compared to the working spouse. Current legal systems attempt to bridge this with alimony or spousal support, but alimony is notoriously difficult to enforce long-term and can be easily modified or terminated. An insurance product designed to replace that lost income or provide a structured settlement could theoretically offer more stability than a court order that relies on the future income potential of an ex-spouse who may relocate, lose their job, or simply stop paying. However, we must also address the moral hazard. The moral hazard is a classic economic concept where the existence of insurance changes the behavior of the insured. If you have a policy that pays out a significant sum upon divorce, Does that make you more likely to call it quits when the marriage hits a rough patch? Critics argue that such products commodify marriage and remove the necessary friction that encourages couples to work through their problems. Conversely, proponents argue that financial stress is one of the leading causes of divorce. By removing the financial fear of leaving, you might actually alleviate the pressure that leads to toxic environments, allowing couples to either heal or part ways with dignity rather than financial warfare. Throughout this series, we will peel back the layers of this industry. We will look at how actuarial science could ever possibly calculate the risk of two people falling out of love. We will examine the legal barriers, as many states have historically been resistant to the idea of enforcing contracts that seem to encourage the dissolution of the marital bond. We will look at the role of captive insurance companies, the potential for employer-sponsored benefits, and the impact this could have on the broader U.S. economy. You are here because you understand that the old ways of navigating financial life are failing. You are here because you want to understand how risk is priced, how wealth is protected, and how the future of the American family might be managed in a world where nothing feels permanent. This is not just a documentary about insurance. It is a documentary about the intersection of human emotion and cold, hard economics. Over the next 9 segments, we will go deep. We will look at case studies from other countries where similar concepts have been explored. We will analyze the data on litigation costs. We will talk to the experts who are trying to build the infrastructure for this market. By the end of this journey, you will have a comprehensive understanding of why this is one of the most intriguing frontiers in modern financial planning. Stay tuned because the next step is to examine the actual structure of marital risk in the United States. To understand why the conversation around divorce insurance is gaining momentum in 2026, we first have to look at the anatomy of marital risk. We are not just talking about heartbreak. We are talking about the systematic dismantling of a financial entity. When a marriage occurs, it functions much like a joint venture. You merge your assets, you share your liabilities, and you align your long-term economic trajectories. When that venture dissolves, the process of unwinding it is often governed by a legal framework that was designed for a different era. Imagine a couple, Sarah and Mark, both 45 years old, living in a major metropolitan area. They have been married for 15 years. They have a mortgage, a combined 401k portfolio, and 2 children in private school. Their life is structured around the efficiency of their combined income. Their household operates with the assumption that this base of operations is permanent. Then a separation occurs. Suddenly, the economy of scale vanishes. They now have to fund 2 separate households. The legal fees for a standard divorce in the United States, even when relatively uncontested, can easily run into tens of thousands of dollars. If it becomes a high-conflict proceeding, those costs can skyrocket to $50,000 or more. This is capital that is effectively burned, drained from the family's net worth and transferred to the legal industry. The risk here is not just the cost of the legal process. It is the permanent loss of asset value. When a court forces the sale of the primary marital residence to satisfy a division of property, that family loses the long-term appreciation potential of that asset. If retirement accounts must be split via a qualified domestic relations order, or QDRO, the compound interest growth of those accounts is interrupted. The loss is not merely the cash value at the time of the split. It is the lost decades of investment growth that would have occurred had that capital remained intact. This is the hidden tax of divorce. Look at the statistics as of 2026. The divorce rate for first marriages in the United States hovers around 41%. For second and third marriages, the failure rates climb significantly higher, reaching 60 and 73% respectively. These are not just numbers. They are indicators of high financial volatility. If any other business venture had a 40+% chance of failing within the first decade, investors would demand some form of risk mitigation or insurance product to protect their position. Yet, in the realm of marriage, we rely on the post hoc intervention of the court system. Consider the concept of gray divorce, which is now a dominant trend in the U.S. More than 1/3 of all divorces now involve adults over the age of 50. At this life stage, the economic consequences are severe. A woman who sacrificed career advancement to focus on caregiving and household management may find herself at 55 with limited time to rebuild a retirement portfolio. The decline in standard of living for women in this demographic following a divorce can reach 45%. For men, while the immediate standard of living impact might be slightly lower, they often face the sudden loss of the primary asset, the home, and the complications of splitting pensions and Social Security benefits. When you reach this age, You do not have the luxury of time to recover from a massive financial shock. Plus 2. The current legal environment is also becoming increasingly complex due to the nature of modern assets. In decades past, marital wealth was relatively easy to identify: the house, the car, the bank accounts. Today, a marital estate might include cryptocurrency holdings, digital assets, equity in early-stage startups, and complex compensation packages like restricted stock units. Valuing these assets in a volatile market during a period of emotional high conflict is a recipe for catastrophic financial loss. Lawyers spend thousands of hours just trying to locate and value assets. This creates a scenario where the legal bill alone can swallow a significant portion of the total net worth. We have to ask why our financial systems have not adapted to this reality. We have insurance for almost everything. We have life insurance to protect against the premature loss of income. We have disability insurance to protect against the loss of the ability to work. We have liability insurance to protect against accidental damage to others. Divorce, which is statistically more likely than most of the events we insure against, remains largely unaddressed by the formal insurance market. Think about the ripple effect on children. Data shows that parental divorce can have long-term impacts on the economic potential of the children involved, including reduced lifetime income and lower educational attainment. This is a societal-level economic issue. If there were a mechanism to provide a more stable financial transition for households, could that potentially mitigate some of the negative outcomes for the next generation? That is a question that economists are only now beginning to model with any real seriousness. The structural problem is that marriage is legally viewed as a union of persons, but economically, it is a merger of estates. The current system relies on judicial discretion to resolve the division of those estates. That discretion is subjective, inconsistent from state to state, and inherently expensive. If we move toward a model where financial risk is managed through private, contractual instruments rather than public litigation, we change the entire incentive structure of the separation process. But we have to be careful. We are not talking about a simple policy that pays out a check when you leave your spouse. That would create a perverse incentive. We are talking about potential models like structured insurance policies that could provide for specific, defined financial transitions, covering the cost of legal fees so they do not drain the household equity, funding the education of children during the transition period, or providing bridge support that is independent of the volatile earnings of an ex-spouse. These are complexities that require a complete rethinking of how we define marital risk. The reason this is such an important topic is that we are witnessing a shift in the American psyche. Couples in 2026 are increasingly pragmatic. They are looking for ways to plan for the worst while hoping for the best. They are using prenuptial agreements more than ever before, not out of cynicism, but out of a desire for clarity and control. Divorce insurance could be the natural evolution of that trend, a market-based solution to a persistent, high-stakes financial problem. However, the barriers to entry for such a market are immense. How do you price the risk of divorce? How do you prevent fraud? How do you ensure that these policies do not interfere with the state's interest in fair and equitable asset division? These are the questions that keep the insurers, the lawyers, and the regulators up at night. And these are the questions we are going to tackle as we move deeper into this series. We have established the nature of the risk and the scale of the financial impact. Now, we need to look at who is actually trying to solve this. Are there companies already working on these products? What are the legal roadblocks that currently prevent the widespread adoption of such insurance? And what can we learn from other jurisdictions that have experimented with similar concepts? We are moving into the mechanics of the market, and you will see that the path to a viable product is far more complex than it appears on the surface. We are going to examine the legislative landscape and the insurance industry's own resistance to this frontier. You do not want to miss the next step because that is where the real disruption begins. The reality of creating a market for divorce insurance is not a simple matter of writing a policy and selling it to the public. It is a fundamental collision between the romantic ideals of marriage and the cold mathematical reality of actuarial science. In the United States as of 2026, the insurance industry is largely resistant to this concept, and for reasons that go far beyond mere corporate skepticism. To understand why this sector remains in its infancy, we have to look at the massive technical and structural barriers that prevent these products from entering the mainstream. Consider the role of an actuary. Their entire profession is built on the ability to predict the frequency and severity of future events. When they price life insurance, they use mortality tables, data points that are incredibly precise because human death, while tragic, is statistically predictable across large populations. Life insurance is stable because there is no incentive for a person to intentionally trigger a claim. Now, contrast that with the concept of divorce. Divorce is not just an event that happens to you. It is a choice you make. This introduces the massive problem of moral hazard. If a policy pays out a significant sum upon the finalization of a divorce, how can an insurer prevent an individual from essentially creating the conditions for a breakup? This is the primary hurdle. In traditional insurance, you cannot easily profit from the event you are insuring against. But in marriage, the lines are blurred. If the payout is large enough to be meaningful, it becomes a financial incentive for one or both parties to seek an exit, especially when the marriage becomes difficult. Actuaries have yet to develop a robust, industry-standard model that can effectively price this behavioral risk. Furthermore, there is the issue of adverse selection. This happens when the people most likely to purchase a policy are the ones who are already planning to get a divorce. If the pool of insured couples consists only of those who suspect their relationship is failing, the entire risk pooling mechanism collapses. To make such a product viable, an insurer would need a massive diverse pool of participants, thousands of stable, happy couples who never expect to collect a claim balanced against a small percentage who do. Without that scale, the premiums would have to be prohibitively expensive, which defeats the purpose of providing an affordable safety net for the average family. Let us look at a case study from the past. In the early 2010s, a company called Safeguard Guarantee Corporation attempted to launch a product called Wedlock. It was marketed as a way for couples to protect against the high costs of legal fees and the loss of income. The product failed, and it failed because it ignored the complexity of the risk. It used a flat premium model that did not account for variables like the length of a marriage, the presence of children, or the individual financial health of the spouses. It was a blunt instrument in a world that required a surgical one. The industry saw this failure and became even more convinced that divorce was an uninsurable risk. Plus one. But that was over a decade ago. The landscape in 2026 is vastly different. We have access to big data, sophisticated AI-driven underwriting, and a growing societal acceptance of prenuptial and postnuptial agreements. Some financial planners are now beginning to explore private, captive insurance structures, where families or high-net-worth individuals pool their own risk in a controlled environment. This bypasses the need for a massive public insurance market by creating a closed-loop system where the incentives are aligned. There is also the legislative hurdle. In many states, the courts have a specific mandated role in the division of assets. A private contract that attempts to dictate the financial outcome of a divorce could be seen as an attempt to circumvent the authority of the judge. If a couple signs an insurance policy that mandates a specific payout, will a court honor that if it conflicts with state law? In many cases, the answer is unclear. This legal uncertainty creates a massive risk for any insurance company looking to enter the space. They do not just need to price the risk of the divorce, they need to price the risk of the legal system invalidating their product. Plus one. Think about the implications of the Ensuring Child Health Coverage Compensation in Divorce Act of 2026. This legislation, currently being debated, aims to force health insurers to directly reimburse divorced parents for out-of-pocket medical expenses for their children. It highlights a recurring theme. The legal and insurance systems are struggling to adapt to the reality of the post-divorce economy. We are seeing a slow legislative patchwork approach to a problem that arguably requires a comprehensive, market-based solution. Why does this matter to you? Because the lack of this insurance means that when a family unit splits, the economic burden falls almost entirely on the individuals. It is a private, often secret, often devastating financial collapse that the broader economy does not account for. If we were to build a viable market for this, we would be talking about a fundamental shift in how Americans manage their household wealth. We would be moving from a culture of reactive, expensive litigation to a culture of proactive, risk-managed planning. The industry resistance is not just about the difficulty of the math, it is about the cultural and moral complexity of the topic. Insurance is traditionally seen as a way to return to the status quo after a loss. But divorce is not a return to the status quo. It is a permanent change in status. Reinsuring that change is an entirely different category of product that requires an entirely different approach to risk. We are just beginning to scratch the surface of the innovations that could make this possible. We are talking about blockchain-based smart contracts that could automatically distribute assets based on predetermined agreements, reducing the need for expensive legal intervention. We are talking about dynamic premiums that adjust as the risk factors in a marriage change over time. We are talking about a future where the financial volatility of a breakup is something you can hedge against, just like you hedge against a market crash or a house fire. As we move forward, we need to ask ourselves if we are actually ready for this. Are we ready to treat marriage as a contract that can be managed by actuarial science? Are we ready to accept the implications of commodifying the end of a relationship? The next step in our deep dive is to look at the role of these modern technological solutions. How could things like smart contracts and decentralized finance change the equation? We are going to explore the cutting edge of the industry, where the most visionary thinkers are trying to solve the problems that the traditional insurance giants have abandoned. The disruption is coming, but it will not look like the insurance industry, We are about to look at the new frontier of private risk management and the potential it holds for the future of the American household. The promise of technology in the world of financial risk management is often centered on transparency and the removal of the middleman. When we talk about the future of divorce insurance, we are talking about moving away from the slow, opaque, and expensive world of traditional insurance giants and into the world of decentralized, automated contracts. By 2026, the rise of blockchain technology and smart contracts has provided a new theoretical architecture that could solve some of the most persistent problems in this space. Imagine a couple, David and Elena, residing in Chicago. They decide to enter into a marriage contract that includes a digital, smart contract-based insurance policy. This is not a paper policy held in a drawer. It is a piece of code existing on a secure, distributed ledger. The policy contains specific, pre-agreed conditions for a payout, triggers, if you will, that are verified by independent data sources known as oracles. For example, if a legal decree of dissolution is filed and recorded in the state database, the smart contract automatically detects this event. The funds, which have been held in escrow since the inception of the policy, are then released according to the predetermined terms. This structure solves the issue of transparency. In a traditional system, an insurance company might dispute a claim, leading to a long and costly process. With a smart contract, the terms are immutable. If the conditions are met, the payout happens. This removes the administrative overhead and the adversarial nature of claims processing. It also potentially lowers the cost of the insurance itself, as it removes the need for large teams of adjusters and legal representatives to negotiate the settlement. Furthermore, consider the potential for microinsurance. In the current model, insurance is typically a large, expensive, multi-year commitment. But what if you could purchase insurance in smaller, targeted increments? Imagine if David and Elena could insure specific assets or specific time periods of high financial risk, such as the early years of building a business together. This would be a more flexible, adaptive approach to financial planning. It treats the risk of divorce as a series of manageable, distinct events rather than one monolithic, uninsurable hazard. The role of decentralized finance or DeFi in this scenario is also significant. By allowing individuals to pool their own resources, you create a system that is governed by the participants themselves rather than by a profit-seeking corporation. Think of a cooperative model where couples pay into a pool. If a member of the pool experiences a divorce, the collective funds support the transition. This is essentially a modern high-tech version of a mutual aid society. It creates a community-based incentive structure where everyone has an interest in maintaining the health of the collective. However, we must address the reality of the technology. While the theoretical potential is vast, the implementation remains in the early experimental stages. As of 2026, we are seeing some early-stage platforms that are experimenting with these concepts, but they face significant regulatory hurdles. The US government is still determining how to classify these smart contract-based insurance products. Are they insurance? Are they derivatives? Are they something else entirely? These classifications will dictate the regulatory landscape for years to come. The risk of this model is the vulnerability of the technology itself. If the code in the smart contract has a flaw, the funds could be lost. We have seen incidents where bugs in DeFi platforms led to significant financial losses. When you are dealing with something as important as the financial security of a family post-divorce, the reliability of the system is paramount. You cannot simply roll back a smart contract in the same way you can correct a clerical error in a bank's database. Despite these challenges, the trajectory is clear. We are moving toward a world where financial risk is managed through automation. The potential for this technology to change the economic landscape is profound. It could democratize access to financial protection for households that currently cannot afford the high premiums of bespoke insurance products or the high cost of expensive legal advice. It shifts the power from the central authority to the individual, providing a new way to build financial stability in a volatile world. Yet, even with this technology, we still have to confront the central uncomfortable truth. Money does not solve the underlying emotional, psychological, and social causes of divorce. While we can and should look for ways to manage the financial fallout, we must not lose sight of the fact that we are dealing with human lives. This is the crucial balance we must strike as we continue our investigation. We are looking for economic solutions to human problems, and there is always a danger that in our desire to optimize for efficiency, we miss the human element. As we progress in this documentary, we must look at the human cost and the sociological factors that often get buried in the economic data. We are talking about families, about children, and about the long-term emotional impact of financial stress. We have looked at the anatomy of the risk, the failures of the traditional insurance model, and the potential of modern technological solutions. Now it is time to look at the broader societal impact of these trends. How would a world with widespread, effective divorce insurance change the institution of marriage itself? Would it make us more likely to marry? More likely to divorce? These are deep structural questions about the nature of our society that we have yet to explore. The next step is to examine the behavioral economics behind this topic. We have to understand how people perceive risk, how they make decisions about marriage, and how the availability of financial safety nets influences those decisions. We are moving beyond the code and the statistics into the realm of human psychology, and you will see that the most surprising findings are not about the money, but about the way we think about the people we share our lives with. You do not want to miss the next segment, as we start to pull back the curtain on the way human behavior interacts with these new, powerful economic tools. The true disruption, as you will see, is not just in the insurance, it is in how we view the partnership of marriage itself. The intersection of human behavior and financial planning is where the most fascinating, and often contradictory, patterns emerge. When we introduce the possibility of divorce insurance into the psychological landscape of a marriage, we are not just talking about money. We are talking about changing the fundamental incentive structure of one of the most significant personal commitments an individual can make. To understand the behavioral economics at play, we have to look at how humans perceive risk, how they calculate the value of a long-term commitment, and how the presence of a safety net changes the threshold at which they choose to stay or walk away. Consider the concept of the commitment problem. In game theory, the commitment problem occurs when two parties cannot reach an optimal outcome, because they cannot trust the other person to follow through on a future action. Marriage is, at its heart, an attempt to solve this problem. You commit to a joint future, hoping that this public and private declaration will bind you to one another through the inevitable challenges of life. But what happens when you introduce a financial hedge? Some theorists argue that this could actually strengthen the commitment. If you know that your financial survival is secured regardless of the marital outcome, you may be more likely to stay in the marriage because you are not being forced to make a decision based on fear or desperation. You are, in essence, removing the economic anxiety that often poisons a struggling relationship. However, the counter-argument is just as compelling. If the exit costs are lowered, does the threshold for what constitutes an acceptable marriage change? In behavioral economics, this is known as the substitution effect. If the cost of divorce is reduced, the relative cost of staying in an unhappy marriage increases. If you can leave with your financial future intact, why would you endure a relationship that is no longer meeting your needs? Historical trends in divorce rates have often been correlated with changes in economic independence. As women entered the workforce in greater numbers, giving them the ability to support themselves outside of marriage, the divorce rate rose. This does not mean that marriage became less valuable. It means that the necessity of staying in a marriage for survival decreased. Imagine a couple, Robert and Julia, who have been married for a decade. They are in a stagnant relationship. They stay together largely because the thought of dividing their assets, losing their home, and potentially damaging their financial security for retirement is too overwhelming. They are effectively trapped by their own wealth. Now, imagine if they had a divorce insurance policy that provided a clear, defined transition payment. It would not make them wealthy, but it would provide enough of a floor to allow them to maintain a baseline standard of living. Would that make them more likely to end the marriage? Or would it simply allow them to engage in more honest, less fear-based communication with each other? This is the critical question. The potential outcomes of such a policy are complex. We could see a period of increased divorce rates initially, as people who were previously trapped by financial fear take the opportunity to leave. Over time, however, we might see a more stable landscape where marriages are entered into with greater transparency, and where the financial terms of the partnership are clearly defined from the start. This is the argument for normalization. If the financial consequences of divorce are known and managed through insurance, the emotional and strategic complexity of the divorce process itself might be reduced. We also need to consider the impact on the decision to marry in the first place. For many young people in 2026, the high cost of a potential divorce is a deterrent to marriage. They see the horror stories of their parents or friends and they become risk-averse. They choose to cohabitate, to keep their finances separate, and to delay or avoid the legal commitment of marriage. If divorce insurance were to become a standard, affordable, and widely accepted product, could it actually encourage more people to take the step into marriage? By mitigating the downside risk, we might make the upside of the partnership more attractive to a generation that values financial security above all else. This is where the distinction between a rational economic actor and a real human being becomes blurred. Humans are not always rational, and our decisions about marriage are deeply influenced by culture, religion, and social expectations. We cannot treat marriage as a simple business contract. It is a social, emotional, and legal institution. The challenge for any insurance provider is to create a product that respects the complexity of this institution, while providing the clarity that a modern, pragmatic society demands. We must also look at the role of signaling. When you purchase divorce insurance, what are you telling your spouse? Are you saying you are preparing for the end? Or are you saying that you value our financial future enough to ensure it is protected regardless of what happens? The way this product is framed and marketed will be just as important as the mechanics of the policy itself. It could be seen as an act of bad faith, or it could be seen as the ultimate act of responsible adult planning. The most successful insurance products are those that become invisible. They are there when you need them, but they do not interfere with your daily life. The challenge for the divorce insurance industry is to move past the novelty and the controversy, and to become a standard tool in the financial planning toolkit. This will require a level of innovation that we have yet to see. It will require companies to move beyond the traditional models of risk, and to embrace the complexities of human relationships. We have explored the anatomy of the risk, the legal and technical hurdles, the potential for technological disruption, and now the behavioral economics of the decision. We are getting a clearer picture of why this is such an intriguing and difficult challenge. But we have only scratched the surface of how this could change the American family. In the next part, we are going to look at the global context. We are going to see what other countries are doing and what lessons we can learn from their experiences. We are going to see if there are models that have already been implemented, and what their successes and failures can teach us about our own future. This is not just a US-centric issue. It is a global phenomenon, and the solutions are being tested in corners of the world you might not expect. You do not want to miss the next step, because the international perspective provides a reality check that is essential for understanding the true potential of this market. The global race to solve this problem is on, and the results are anything but predictable. When we look beyond the borders of the United States, we see a fascinating landscape where the concept of divorce insurance is not a unified reality, but rather a series of experimental, often unsuccessful, or highly niche attempts. There is no country in 2026 where you can walk into a local insurance office and buy a standard policy to hedge against marital dissolution. Instead, we see various jurisdictions grappling with the same fundamental problem: how to mitigate the financial shock of a broken marriage without destabilizing the societal and legal foundations of the institution itself. Consider the European context. Many European nations have legal systems that place a higher emphasis on state-mandated financial support and equitable distribution than we see in the United States. In countries like Germany or France, the legal framework often includes comprehensive spousal support requirements that automatically kick in upon separation. These systems act as a form of state-provided, involuntary insurance. You do not buy a policy. You pay into the system through taxes and adhere to judicial standards that are designed to prevent the extreme wealth disparity that can occur after a divorce in the US. The lesson here is that some countries choose to solve the problem of divorce-related poverty through legislative mandates rather than through the private insurance market. There have been private attempts, particularly in niche markets. In the United Kingdom, for instance, there have been occasional efforts by high-end specialty insurers to offer tailored financial products for high-net-worth individuals, often marketed as bespoke wealth preservation strategies. These are not mass-market products. They are highly customized, multi-party contracts that are structured more like investment hedges than traditional insurance. They are designed to protect specific assets or to ensure the continuity of a family business during a period of marital uncertainty. These products demonstrate that the concept is possible, but only at an elite level where the cost of the premiums and the complexity of the legal structuring are not barriers to entry. Think about Japan, a country where the legal system is often criticized for its rigidity regarding custody and financial division. We have seen interest from Japanese insurers in developing new lines of business that can address these gaps. As these firms expand into international markets, they are looking for ways to provide services that go beyond traditional life or property insurance. They are experimenting with modularized products that can be customized for different stages of life, including the dissolution of a partnership. The goal is to provide a service that is more flexible than the rigid, court-mandated processes of the past. The global race to solve the problem of marital economic volatility reveals a crucial truth. The market-based solution we are looking for is essentially a high-end, complex, and highly regulated product. It is not a commodity. It is not something that can be easily simplified. The lessons from these international attempts are clear. First, the more the product relies on the unpredictable nature of judicial discretion, the more expensive and difficult it becomes to insure. Second, the most successful approaches are those that are integrated into a broader wealth management or life planning strategy, rather than standing alone as a single policy. We are seeing a trend toward what we might call private ordering. Instead of relying on the state or a standardized insurance product, individuals are increasingly using sophisticated legal instruments, like robust, AI-assisted prenuptial agreements, to create their own, private financial frameworks. These agreements serve as the infrastructure upon which any future insurance product would need to be built. They define the assets, the expectations, and the consequences of a separation, thereby creating the predictability that insurers need to write a policy. The marriage of private legal ordering and market-based insurance is the most likely path forward. The challenge is that this requires a level of planning and foresight that is not currently part of the American cultural ethos regarding marriage. We are taught to marry for love, to ignore the money, and to trust that it will all work out. To embrace a system where the potential of divorce is managed as a financial risk requires a fundamental change in how we approach the entire institution. It requires us to view the marriage as a partner in a financial venture, and the insurance as the tool that manages the risk of that venture. This is where the story gets really complicated. We have seen that the solution is not a simple policy, but a shift in the entire paradigm of how we prepare for the end of a marriage. We are looking at a future where legal tech, artificial intelligence, and specialized financial products come together to form a new, more stable foundation for the American family. But what does this mean for the people who cannot afford these high-end bespoke solutions? What about the millions of Americans who do not have the resources to build a complex, legal and financial fortress around their marriage? That is the next and perhaps most critical question. We need to examine if this trend is widening the gap between the haves and the have-nots in our society. The next step is to look at the equity of these potential solutions and whether they risk creating a two-tiered system for marriage in the United States. You do not want to miss this part, because the implications for the future of the average American household are profound. We are moving toward the final pieces of this puzzle, and the picture that is emerging is one that will fundamentally change how we think about our lives, our partners, and our future. The democratization of financial protection is perhaps the most significant hurdle in the potential adoption of divorce insurance within the United States. As of 2026, we see a clear divide. On one side, we have high-net-worth individuals who can afford the expensive legal fees required to draft ironclad prenuptial agreements and access specialized wealth management services that function as a form of self-insured protection. On the other side, we have the vast majority of the American public, for whom the legal and financial costs of a divorce are a devastating, often life-altering event. If we create a market for divorce insurance that is only accessible to the elite, we are not solving the economic problem. We are simply creating a two-tiered system of marital stability. Imagine the situation of a middle-class family, perhaps the Miller family in Ohio. They own a modest home, have 2 children, and both parents work to maintain their standard of living. When a divorce occurs, they do not have the luxury of custom-designed financial structures. They are subjected to the standard, court-mandated division of assets, which often includes the forced sale of their home and the depletion of their retirement accounts to cover the expenses of the split. For them, the economic blow is not just a temporary inconvenience. It is a permanent setback that can lead to years of financial instability, reduced savings for their children's education, and a lower quality of life in their later years. The economic potential of divorce insurance lies in its ability to offer a standardized, affordable product for this demographic. If we could develop a policy that provides a predefined, structured payout to cover essential transition costs, such as moving expenses, temporary housing, or the legal fees associated with a simple uncontested filing, we could change the trajectory of these divorces. This would require a pooling of risk across a broad population, similar to how auto or homeowners insurance functions. But to achieve this, we need to overcome the massive structural and psychological barriers we have discussed. One potential path toward this accessibility is employer-sponsored benefits. Imagine if, in the near future, large U.S. companies began offering a divorce protection benefit as part of their standard compensation package, similar to life or disability insurance. This would allow for a large, diverse pool of participants, which is essential for the actuarial health of any insurance product. It would also remove the need for individual couples to go through the complex process of purchasing a private policy. This could be a powerful tool for employee retention and financial well-being, as it would provide a safety net for workers who are facing one of the most stressful and economically draining events in their lives. However, the resistance from employers and insurers is significant. Many companies are hesitant to involve themselves in the personal lives of their employees to this extent. There is a concern that such a benefit could be seen as an admission that divorce is expected, or worse, that it could lead to potential conflicts of interest. Furthermore, insurers are still struggling to build the necessary data models to price such a product accurately. They are concerned about the lack of historical data and the potential for abuse. As we have seen, the fear of moral hazard is the primary obstacle to the widespread availability of such products. The equity issue is also tied to the role of the state. If the private market fails to provide an affordable solution, should the government intervene? Some policy experts are beginning to discuss the possibility of state-level programs that provide a basic, government-funded safety net for individuals going through a divorce. This would be a form of social insurance, similar to unemployment or workers' compensation. It would ensure that every citizen has a minimum level of financial protection during a transition. While this is an extreme and currently unlikely proposal, it underscores the severity of the economic problem we are facing. Think about the long-term impact on social mobility. Divorce is one of the most common ways for families to fall out of the middle class and into poverty. If we had a mechanism to stabilize these households, we could potentially see a massive positive shift in long-term economic outcomes for both parents and children. This is not just a niche insurance product. It is a potential tool for addressing one of the most persistent drivers of inequality in the United States. It is a way to protect the economic foundation of the American family. The challenge is that this requires a shift in how we view the public-private partnership. We have to decide if the financial fallout of divorce is a private matter that individuals must solve on their own, or if it is a societal challenge that requires a more comprehensive, systemic response. The current path of reliance on an adversarial, court-based system is increasingly seen as inadequate. We are in a state of transition where the old ways are failing, but the new ways have not yet been fully realized. As we look toward the final parts of this series, we need to bring all these threads together. We have explored the risk, the technology, the psychology, and the global and societal dimensions of this issue. Now, we must synthesize this into a vision of what the future could hold. We are going to look at the practical step-by-step evolution that could lead to a viable market for divorce insurance in the U.S. We are going to examine the roles that different stakeholders, from the insurance companies to the legal community to the policymakers, will need to play. The final pieces are about to fall into place, and you will see that the solution to this problem is not a single product, but a multifaceted evolution of our entire financial system. You do not want to miss the next step, because that is where we move from the theoretical to the potential future of the American household. We are about to look at the concrete actions that could turn this concept into a reality. The transition from a theoretical concept to a functional market for divorce insurance requires a sophisticated alignment of legal innovation, technological infrastructure, and public policy reform. As we look at the landscape in 2026, the pathway forward is not merely about an insurance company deciding to launch a new product. It is about building an ecosystem that can support the high level of complexity and risk management this product requires. We are talking about a collaborative effort involving tech developers, legal professionals, and financial architects who are beginning to recognize the immense, untapped value in this sector. Consider the role of legal technology. One of the greatest barriers to any insurance model is the cost and uncertainty of the legal process. By utilizing advanced, AI-driven legal tools, we can standardize the documentation process for marriage. This would include digitized, smart contract-ready prenuptial and postnuptial agreements. If these agreements are standardized, they become readable and enforceable by automated systems, which in turn significantly reduces the uncertainty that currently makes divorce a risky, unpredictable financial event. If an insurer can rely on a standard, digital record of a couple's assets and liabilities, they can calculate the risk of a potential payout with a much higher degree of accuracy. Imagine a scenario where a couple, like James and Linda, residing in Texas, uses a platform that integrates their financial planning with the potential insurance product. At the time of their marriage, they input their assets, their projected income, and their long-term financial goals into an encrypted digital vault. This information is then used to structure a tailored insurance policy that adapts as their financial life evolves. If they buy a house, the policy adjusts. If their business grows, the policy adjusts. This is a dynamic, living instrument, not a static, one-time purchase. It is the integration of wealth management and risk protection that creates the stability that families crave. The next phase of this evolution involves the creation of captive insurance pools. We are already seeing high-net-worth families utilizing private, captive structures to manage their own risk. As these models become more sophisticated and lower in cost, they could be adapted for smaller, collective pools, such as professional associations or even neighborhood cooperatives. By pooling the risk of a limited group of participants who share similar financial profiles, you can bypass the need for a massive public insurance market while still achieving the benefits of risk spreading. This would be a bottom-up approach, where the market is built by the users themselves, rather than forced upon them by large, profit-seeking corporations. We must also look at the role of the judiciary. If these private, insurance-backed settlements are to become standard, they need the cooperation of the state. We need legislative action to create a clear, predictable legal framework that recognizes and enforces these insurance-based agreements. If a couple has a policy that defines the division of assets, a judge should be able to rely on that as a valid, binding resolution. This requires a shift in the philosophy of the family law system, from one that is purely adjudicatory to one that is facilitative. The goal is to provide a framework that allows couples to exit their marriage with the minimum amount of financial disruption and the maximum amount of certainty. This evolution is already happening, albeit slowly. We are seeing a new generation of lawyers, financial planners, and technologists who are dedicated to this, not because they want to profit from divorce, but because they recognize the inefficiency and the damage of the current system. They are the architects of the new modern way of managing the financial life of the family. They are the ones who are creating the platforms, the policies, and the legal frameworks that will define the future of this sector. However, we must remain grounded in the reality that this is a long-term project. There are no quick solutions. We are talking about changing the fundamental centuries-old way that society manages the end of a partnership. This will take time, effort, and a significant shift in public perception. It will require us to be patient, to be rigorous in our analysis, and to be willing to experiment with new, and sometimes unconventional solutions. The potential is immense, but the path is not easy. We have now examined the risk, the technology, the psychology, the global context, the equity issues, and the concrete, actionable steps toward a future market. We have a comprehensive view of the challenge and the potential for a solution. In the final two parts of this series, we are going to synthesize everything we have learned into a clear, vision-based summary. We are going to look at the long-term impact on the American family and the broader economy, and we are going to reflect on whether this is the future we actually want to build. The final pieces of this masterclass are about the big picture, the societal transformation that could result from these changes. You do not want to miss the next step because we are moving from the technical details to the philosophical implications. We are going to ask the most important question of all. Is this the future that will make our lives more stable, more secure, and more resilient to the challenges of the modern world? We are about to enter the concluding phase of this deep dive, and the final synthesis of these complex ideas will provide you with a profound understanding of why this is one of the most important and least understood topics in modern financial planning. As we reach the 9th segment of this masterclass, we must pause to consider the broader implications of what we have discussed. If we were to successfully integrate divorce insurance into the mainstream American financial landscape by the late 2020s, we are not merely discussing a new insurance product. We are discussing a potential shift in the economic resilience of the American household. To understand this, we must look at the macroeconomic benefits of reducing the friction and the catastrophic loss associated with marital dissolution. Consider the potential for increased labor mobility. Currently, many individuals remain in jobs they dislike or in geographic locations that limit their career potential because they are tethered to their spouse's career or their household's financial structure. If the financial risk of a potential separation were mitigated, we might see a more dynamic labor market where individuals have the flexibility to pursue career opportunities, invest in their own education, or relocate for better prospects. This is not about encouraging divorce. It is about reducing the economic penalties of life transitions. When people have a safety net, they are better equipped to take calculated risks that can lead to greater long-term productivity and wealth creation for the economy as a whole. Think about the impact on the housing market. A significant portion of forced home sales in the United States occurs due to divorce. When a home is liquidated under duress, it often happens at a suboptimal price, which can drag down local real estate values and contribute to market volatility. If divorcing couples had the financial liquidity to keep their home during the transition, or if they had the resources to sell it on their own terms, we could see a more stable and efficient housing market. This is a subtle but significant economic effect that is often overlooked in discussions about marital stability. We also need to look at the impact on retirement security. The depletion of retirement accounts during a divorce is a massive, systemic issue that is contributing to the looming retirement crisis in the United States. If an insurance-based solution could protect even a portion of these accounts during a separation, it would have profound long-term benefits for the financial well-being of the aging population. We are talking about the potential to keep thousands of individuals from falling into poverty during their retirement years. This is a clear case study where the societal costs of inaction are significantly higher than the potential costs of implementing a risk-managed solution. However, we must balance these potential benefits against the risk of unintended consequences. Could widespread divorce insurance make our society less cohesive? Could it signal that we have given up on the idea of lifelong commitment? These are not just economic questions, they are cultural ones. When we look at the historical trends, we see that the decline of the traditional, long-term marriage has been a complex process driven by many factors, from the rise of economic independence to the changing role of gender in the household. It would be overly simplistic to suggest that a financial tool is the cause or the solution to these deep-seated social shifts. But it is certainly a factor that we must consider as we look toward the future. The potential for this product to act as a stabilizer is high, but it must be implemented with care. We are not looking for a quick fix. We are looking for a way to manage the reality of a world where divorce is a common and often devastating financial event. The promise lies in the ability to provide a floor of security, not a ceiling of wealth. It is about creating a baseline of stability that allows people to navigate their lives with more dignity, more control, and less fear. Consider the perspective of someone like Marcus, a young professional in 2026. He is planning his future and is hesitant about the risks of marriage. He views his financial life as a critical pillar of his long-term success. If he could integrate a protection layer into his financial strategy, he would be more likely to commit to a long-term partnership. For him, this is not an insurance policy against his spouse. It is an insurance policy against the uncertainty of the world. It allows him to enter into a partnership with a greater sense of confidence, knowing that he has taken the steps to manage his risk. We are also seeing the potential for this to evolve beyond just a financial product. We could see the emergence of a new type of advisory service, where financial planners and legal experts work together to help couples build not just a budget, but a resilient, long-term financial partnership. They would help couples define their goals, structure their assets, and create a plan that addresses the potential for a split, just as they address the potential for death, disability, or a market crash. This would be a proactive, holistic approach to marriage that would redefine the role of the financial advisor in the modern era. This leads us to the final conclusion of our series. We have traveled from the initial shocking statistics of divorce to the complex, multi-layered solutions that the future may hold. We have seen that the problem is not just about the money. It is about the human experience of marriage and the role of financial systems in supporting or destabilizing that institution. We are at a turning point. We can either continue to rely on a broken, archaic system that punishes families for the failure of a partnership, or we can look toward a future that is more transparent, more equitable, and more resilient. The final segment of this series will bring all these pieces together. We will reflect on the big picture, the the potential for societal transformation, and the questions that each of you must now answer for yourselves. You have the knowledge now to understand the true potential of this concept. The final step is to synthesize this into a clear, personal perspective on the future of the American household. We are going to look back on this masterclass and identify the key takeaways that every individual should consider as they navigate their own lives. You do not want to miss this final reflection. It is the core of everything we have been discussing, and it is the conclusion that will leave you with a completely new understanding of the risks and the rewards of the life you are building. The journey we have taken across these 10 segments has been an attempt to navigate the complex, often contentious intersection of human emotion and financial engineering. We began by questioning the status quo, an adversarial system that processes millions of domestic dissolutions annually with little regard for the long-term wealth destruction it causes. We have looked at the actuarial impossibility of pricing love, the innovative potential of blockchain-based smart contracts, the psychological nuances of commitment, and the global efforts to find a more stable path. As we conclude this masterclass in 2026, it is time to synthesize these insights into a coherent vision for the future of the American household. What we have discovered is that the concept of divorce insurance is not a magic wand that can fix a broken relationship. Rather, it is a tool for systemic risk management. The economic value of such a product, if it ever reaches maturity, lies in its ability to transform a catastrophic, unpredictable financial event into a manageable, bounded, and predictable transition. It is the difference between a family losing its home and its future, and a family having the necessary liquidity to navigate a painful, yet stable, financial reorganization. This is the distinction between chaos and orderly transition, and it is a difference that is fundamentally worth pursuing. Think about the broader trajectory of our society. We are living in an era of unprecedented financial complexity. We are managing digital assets, diversified investment portfolios, and complex corporate compensation structures. Our financial lives are more interconnected and more fragile than they have ever been. In this context, the traditional ways of managing the dissolution of a partnership, the court-based division of assets, are showing their age. They are too slow, too expensive, and too disconnected from the reality of the digital-first economy. The potential for a market-based, insurance-driven solution is a response to this reality. It is an attempt to align our financial protections with the complexities of our modern lives. However, the success of this concept depends on our willingness to adopt a more pragmatic view of marriage and its economic risks. We must move past the stigma that surrounds the idea of financial planning for divorce. We must recognize that transparency, communication, and clear, written agreements are not the enemies of romance. They are the foundations of a resilient partnership. Imagine a world where every couple enters a marriage with a full, clear, and shared understanding of their financial status and their exit strategy, supported by a framework that provides security and clarity for both parties. This would be a radical shift from the culture of silence and unspoken expectations that currently defines the norm. The potential outcomes are significant. We could see a reduction in the litigation-driven destruction of wealth. We could see an increase in the long-term financial security of families, particularly those in the middle class who are most vulnerable to economic shocks. We could see the emergence of a new sector in the insurance and financial services industry, one that is focused on the life cycle of the partnership rather than just the individual. This is not about commodifying marriage. It is about creating a stronger, more stable foundation for the families of the future. We must also acknowledge the limitations. No amount of insurance can compensate for the emotional toll of a divorce. No policy can replace the lost time, the disrupted routines, or the impact on children. We must be clear that the economic value is only one side of the coin. The other side is the human one, and the two cannot be separated. The best insurance in the world cannot fix a broken heart, but it can ensure that a broken heart does not also lead to a broken financial future. This is the core of the value proposition, providing a layer of protection that allows individuals to focus on their emotional recovery rather than their immediate survival. The path ahead will be marked by experimentation and failure. We will see startups launch, fail, and evolve. We will see regulators struggle to classify these products. We will see societal debate over the ethics and the implications of this industry. But this is the process of innovation. It is messy, it is uncertain, and it is necessary. The fact that we are even having this conversation in 2026 is a testament to the fact that the old ways are no longer sufficient. We are in the early stages of a fundamental transformation, in how we manage the financial realities of our personal lives. As you reflect on everything we have covered, consider your own position. Are you managing your own financial life with the foresight and the protection that it deserves? Are you building a partnership based on clarity and mutual security? Or are you operating under the assumption that the future will take care of itself? The lesson of this masterclass is not to focus on the worst-case scenario, but to be prepared for the realities of the world we live in. It is about taking control of your financial destiny, being proactive, and recognizing that in a world where nothing is certain, the ability to manage risk is one of the most valuable skills you can possess. We have explored the potential for this industry to grow, the barriers it faces, and the impact it could have on the broader economy. We have looked at the data, the case studies, and the theoretical models. You now have the knowledge to understand the stakes, the risks, and the opportunities of this emerging field. The future of the American household is in the hands of the people who are willing to plan for it, to protect it, and to build it with a clear-eyed understanding of the world as it is, not as we wish it to be. The question that remains, and the one that you must now answer for yourself, is what kind of financial foundation do you want for your future? Are you going to rely on the systems of the past, or are you going to look for the tools of the future? The masterclass is over, but the work of building your financial stability is ongoing. The tools exist, the concepts are maturing, and the necessity is clear. You have the insight. Now it is time to make the decisions that will define the security of your future. We have laid the groundwork, we have debated the possibilities, and we have analyzed the risks. The rest of the journey is yours to take, armed with the knowledge that the most important investment you will ever make is in the stability of your own life.